What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So this is video 2 of 2 today. I want to just go over the recent news with Medical Property Trust. I'm going to show you some links. I'm going to go over some data and some pretty good information about these guys. And if a dividend cut happens, I'm still going to hold. And I'm going to explain to you why. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. Let's check this stock out right now. So recently, Medical Properties Trust has been taking a huge dip. The average volume right now is 17.50 million. The market cap is 4.97 billion US dollars. Year range was 710 to 1997. Its day range was 814 to 834, and its previous close was 824. So I'm going to go over these guys. If you're new to this channel, I'm going to explain to you why I'm buying and holding. There could be a dividend cut. I'm going to show you some data and information that people are revealing. Let's check these guys out as a company. So here's some information on these guys. First of all, they have 444 properties, 44,000 licensed beds, 10 countries, and 55 tenant relationships. I'm going to go over their portfolio. So here's their capital allocation. General acute care hospitals is 68.1%. Behavioral health facilities, oh boy, those guys are high in demand. I can tell you, being a registered nurse, behavioral health is high. And I'm not giving financial advice or medical advice. This is not for entertainment purposes only. Disclaimer in the description. Inpatient rehabilitation hospitals. So people are getting sicker. Heart attacks, strokes. Same thing with long-term acute care hospitals. People are getting amputations, the rise of diabetes. People are getting their legs cut off because they're not taking care of themselves. Freestanding ER urgent care facilities, those are always full. In acute care hospitals, I mean, it is hard to get a bed. With these hospitals, I mean, people are boarding like crazy. There's a nursing shortage. There's a huge shortage in healthcare workers and providers. And since people are getting sicker, the demand is higher. And even with the bug, COVID, okay, my hospital that I'm at right now even said we don't have to wear a mask. I'm still going to wear a mask. So you still have to deal with COVID. You still have to deal with influenza A. They're saying possibly influenza B might be gone completely. There hasn't been a report on those guys or identification with those guys in a long time. So it's been like 2 years since I identified influenza B. RSV, that's another one. C. diff. C. diff is an opportunistic pathogen. So people that are on chronic antibiotics or immunocompromised, this bacteria capitalizes in the gut area and people like crap their brains out. So C. diff is powerful. And again, you know, with people being diabetic, they're a candy store. So the bacteria love the candy and people get infections, infected toes. It's really sad seeing like young people getting dialysis in their 20s and 30s who don't take care of themselves. I've noticed that, and doing a nephrology rotation just in general, it's sad to see the decline of people not taking care of themselves. So all these big things right here are in demand. And to be honest with you, it's only going to get worse. I hate saying that. I wish people would take care of themselves, but you know, there's some job security in healthcare. So we're going to go over their demographics. I'm going to tell you, they have some beautiful properties. So here's Ross Hall Hospital in the United Kingdom, St. Elizabeth's Medical Center, that's in the United States. There's one place in Germany, I can't even say it, I won't even say it. Southern California Hospital at Culver City, that's a big hospital. Knox Private Hospital in Australia. They have a lot of facilities. Look at this place in Switzerland. That's beautiful. So that's one thing. I mean, these are big facilities. It's not like they're small facilities. And I'm going to go over the map. And before I go over the map, look at how many facilities they have. 20 acute care hospitals, 67 behavioral health facilities, 112 inpatient rehabilitation hospitals. I'm going to tell you, they're going to need a lot more behavioral health facilities. It is just crazy right now with mental health. long-term acute care hospitals, and freestanding urgent ER hospitals. So that is huge, especially inpatient rehabilitation hospitals, like you get like injury or illness, stroke, heart attack, cardiopulmonary rehabilitation, things like that. Strokes, amputations, just in general, big injuries that people have, car accidents and stuff. They go to these rehabilitation hospitals. Some of them are beautiful, and you can correct me if I'm wrong, but that's usually what they are classified as. Now, check out how they are demographically. We're going to look at that. I know I keep on jumping around, but I want to show you a few more things because I find some things that I find very interesting. I mean, I'm just looking at these guys geographically. I mean, you see the United States, you see a little bit of South America right here, you see Australia, and you see Europe. So that's one thing that's very attractive. They're in multiple continents and they're big. I mean, they're pretty big. So that's one thing that they have going. That's one of the reasons why I'm holding on to them. But I want to show you the most recent news. I kind of like this article on dividend cut is likely for Medical Properties Trust. Of course, he's not giving financial advice, neither am I. But they're facing an additional headlines to AFFO per share as higher interest rates and wider credit spreads to encourage asset sales. Management made the right choice to sell the Australian portfolio. The cheap financing was going to disappear anyway. Reducing leverage is precisely the right way to combat bears. However, another big step in reducing leverage should be cutting the dividend. So he also mentioned dividend sustainability depends on AFFO coverage. When the AFFO growth rate is negative, that should be concerning. These are material headwinds. MPW chose correctly, but some investors still focus on the old scenario. And they have a trend. They have a large amount of debt. As the maturity is approached, they should continue to deleverage rather than increase debt at a double-digit interest rates. Some investors will argue that MPW might be able to get a better rate in a line of credit with the bank. I agree. I can't find the right words to describe the concept of financing long-term illiquid unhedged assets with a line of credit. The reason MPW was able to get a 5.7 cap rate on that asset was because MPW had time to conduct an orderly process to find a buyer. So this is one thing that he really mentioned that I like as well, that he covered. When a REIT buys real estate in a line of credit, they're usually negotiating long-term financing with banks. It's a short-term tool to cover the period between buying the real estate and issuing the debt to fund the asset. However, we already have evidence that MPW's long-term financing costs more than 10%. When a REIT leaves bonds outstanding at 10% with a 5-year treasuries yield at 3.7%, that's not indicating an abundance of cash. And in its conclusion, I like this. The asset sale is positive for MPW's bonds. Bondholders want to see MPW aggressively following the deleveraging path. It reduces MPW's leverage and reduces the AFFO per share. Generally, reducing the AFFO per share is not healthy for the bondholders. However, in this case, it strengthens the case for MPW to reduce the dividend. Reducing the amount of cash that flows out the door would be great for bondholders who want to see MPW reinvesting into their portfolio and reducing leverage. Most shareholders want the dividend maintained. However, MPW has debts outstanding with a yield of over 10% at market prices. If you find 10% attractive, you don't want the company you own to pay over 10% on their debts. Of course, MPW will report a lower interest expense because the coupon rate is lower. MPW is using correct accounting treatment, though someone in the public comments will create a straw man argument. We're not suggesting any flaw in the accounting. So I'm going to go over a few more things. He also goes to say the second bull case is the idea that MPW will sustain the dividend indefinitely. That argument is severely misinformed. MPW's operating results are very unlikely to support the dividend indefinitely, given the increasing cost of debt. As we highlighted for members previously, MPW's dividend coverage through AFFO relied on stock-based compensation and deferred amortization of financing costs. Stripping those factors out of guidance, payout ratio would be way past 100%. So anything that's above 100% is always a red flag. Again, this is my play money. I was on Russ's YouTube channel, and I kind of said, hey, some play money, see what happens. You don't want to put all your eggs in one basket. I do like how many hospitals are kind of like a landlord to, and how big they are, and geographically how diversified they are, because I'm going to go over a few trends. So if you look at the revenue history of MPW, it's not bad. This is why I'm going to hold on these guys. They'll probably get a dividend cut. I'm assuming this is probably going to happen, where now everybody's predicting pretty much a recession is going to happen. 2016, this is annually in millions US dollars, 541, 2017, 704, 2018, 784, 2019, 854, 2020, 1,249, 2021, 1,544, and then 2022, 1,542. So they did have an increase in revenue. This is why I'm kind of holding on to these guys. I like the diversification. So that's one thing that's pretty nice. I'm going to go over their dividend history briefly. So 2011, it was 20 cents. Now look at this. There's really slow dividend growth. 2020, 2021, they jumped to 21 cents. 2022, 22 cents. Everything was good at that time. 23 cents. 2017, 24 cents. 2018, 25 cents. 2019, 26 cents. 2020, 27 cents. 28 cents. Then 29 cents. And they've been a little stagnant, so you haven't seen a dividend cut. Now, according to Zacks, the payout ratio is 64%. I find it a little bit higher right now. And that 14.10% yield is screaming for a yield trap right now. I don't care right now. Again, this is play money. I'll see what happens. If you bought one share, you made 116. Dividend growth in 5 years is 3.86%. Their number of dividend increases in the last 5 years is 4. I highly doubt they're going to increase their dividend, but I'm going to tell you, I'm still going to keep on buying these guys. If something happens, that's fine. I'm still going to have these guys as a dividend stock. I'm looking at long term. Again, you don't want to have all your eggs in one basket, but I wanted to go over the negative news because I'm still going to hold these guys. Probably buy shares, once they take a hit. So I'll have an opportunity to buy more shares. And, some people are selling it to, compensate with taxes and stuff. But I'm still going to, throw some play money in these guys. There's still a little bit of confidence with them, even if they have a dividend cut. So let me know what you think. If you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. This is Dark Dividend. You guys have a good one. I'm going to have a video for you guys tomorrow.